Hey guys, what's up? We have already covered the 12% of the syllabus, and now we come to the second chapter with the weightage as low as 5%. But this chapter can't be avoided at any cost because it lays the foundation of the series. It talks about derivatives, the types of derivative in the market used by various kind of participants in the market and the platform on which they are traded. So even if the weightage is as low as 5%, this chapter can't be avoided. So now let's begin with the definition of derivative in simple terms. So derivative is a contract between two or more parties whose value is based on an agreed upon underlying financial assets like any security. It could be real asset like properties or equities or foreign exchange, fixed income or interest rate, cash equivalent, stocks, housing, price index. It could be any asset. It could even be an event, okay, at an agreed upon price in future on any date that they choose to settle their contract. Okay, so this is derivative for you in simple terms. Now let's come to what book has in it for us. So your derivative is a financial instrument that derives its value from some other more basic underlying variables. Now by more basic it means whatever the financial instrument is deriving its value from, that particular asset has a price that's closer to the value of it itself. Example is stock. The price of the stock derives its value from the value of the company itself, right? And this underlying variable could be anything. It could be real estate, properties, equity, foreign exchange. It could be anything. It could be anything for which two or more parties are willing to come into a contract for, right? So as per Securities Contract Act 1956, derivative is a security derived from a debt instrument, share, loan, whether secured or unsecured, risk instrument, or contract for differences or any other form of security. And the definition also includes a contract which derives its value from the prices or index of prices of underlying security. Derivatives are securities under the Securities Contract Regulation Act, and hence the trading of derivatives is governed by the regulatory framework under the Securities Contract Regulation Act. Sounds like difficult to understand, isn't it? But here you just gotta remember the Security Contract Regulation Act of 1956 includes the definition of derivative and what derivative actually means, which is equivalent to this that has been explained before. Okay, so there's nothing to worry. Each type of derivative has different properties and are used at different times. We will cover all of that, okay? Now, the example of wheat farmer in a bakery is the most common example used in derivatives. Okay, so now let's first talk about that. This can help you in understanding what derivative actually means. So this farmer must have incurred some expenses in the process of growing wheat, right? But now this farmer is apprehensive about the price of the wheat falling down. What if that happens? The margin of profit would be really low, right? Now he wants to protect himself from being faced such a situation when the price of the wheat would fall down. And here this baker is apprehensive about the rise in the price of the wheat. If that happens, so before starting with the types of derivative market, let's first understand the difference between OTC traded derivative and exchange traded derivative. Now under exchange trade, a clearing counterparty exists between the buyer and the seller, whereas in OTC traded, buyer and sellers bilaterally make the settlement. This means that here the parties might know each other, but here there is little to no chance of the parties knowing each other. And due to the existence of clearing counterparty, there are more regulations. So this is more regulated, whereas this is less regulated, as the agreement is only made between the buyer and the seller. There is no third element here. There exists a counterparty risk, which means a risk of default that may arise from a borrower failing to make required payment. So here that risk exists due to less regulation, whereas under exchange traded derivatives, the counterparty risk is eliminated. Now, derivatives under exchange traded are more standardized. There is a specific contract size or contract lots in which you have to buy the derivative, whereas in customized, there is no such specification of any contract size or lots in which it has to be bought. Now, contract size has been discussed in details in the upcoming videos, but for now just know that it's like a wholesaler selling goods in lots and not just piece by piece. Okay, so here there exists a specific contract size, while in customized there is no such specification. The exchange is the centralized system of trading with a well-organized network of people, whereas securities that are traded over the counter are traded through the dealer. So here there is no centralized system and lacks well-organized network of people. This can be operated at any time because it is done through the dealer, while exchange trades can't be operated at any time because it requires the availability of intricate network. Also, one point that I would like to add is, in order to eliminate counterparty risk, the participant has to deposit margin money so that this clearing counterparty can guarantee the elimination of default risks. Here you need to deposit a margin money, while under OTC there is no such requirement. This is how you would distinct exchange traded from OTC traded. Now we are ready to start with the types of derivatives used in the market. So first we'll check the definition and then we'll see how it actually works in the real world. Based on the cash flow pattern and the market in which they are transacted, market you understand now, exchange traded or OTC traded. Derivatives are broadly categorized into the following group: forward derivative, futures derivative, swap derivative, and option derivatives. These are the four main derivative products in the market. Starting with what forward contract stands for. Forward contract is a customized OTC contract between two parties where settlement takes place on a specific date in the future at today's pre-agreed price and no money changes hands before the settlement of the contract. Now we already know OTC contracts are customized and no money changes hand before the settlement of the contract, right? Like any derivative contract, it is made between two or more parties where settlement takes place on a specific date in the future at today's pre-agreed price. Now let's understand the same with an example. Now assume hypothetical garment exporters company A, which is based in India, is heavily exposed to foreign exchange risk and wishes to hedge against its projected payment of $1 million in 3 months. Now what risk does the garment seller is faced with? He has incurred expenses in rupee, but his payment would be made in dollars. And due to the adverse price movement in the market, the foreign exchange rate of these two currencies would not be the same as they were at the time of entering the contract. So now is apprehensive about the depreciation of dollars. So how would he hedge against this risk? Prior to 3 months, the company could sell future contracts on the dollars he will be receiving. They sell dollar future because they are an Indian company and don't need the dollars in their country. Therefore, since they know they will receive dollars, they can sell them now and lock in a rate at which those dollars can be exchanged for INR. Company A sells 1,000 future contract, which is the contract unit of dollar foreign exchange futures, to hedge its projected value of payment, which is this for 10,000 pieces of shirt. Now, if the dollar depreciates against INR, the company's projected payment value would be protected. So you see how this garment exporter hedged his foreign exchange transaction risk by using forward contract. Currency future is very similar to forward except that it is exchange trade product. The only thing that distincts future from forward is that it is exchange traded product. So it is not customized like forwards. It is more standardized and more regulated. And here the money changes hands before the settlement of the contract. Rest is the same. Future contract is a standardized exchange trade product between two parties where settlement takes place on a specific date in the future at today's pre-agreed price. Okay, now let's check the example. The example could be the same as used for currency forward contract, where Utkarsh is exposed to the same transaction foreign exchange risk and wants to hedge himself against the same risk. But here, instead of selling forward contract, he sells future contract. And this contract doesn't happen bilaterally between the buyer and seller. There has to be a clearing house between them. So he sells the future currency to that clearinghouse by depositing a certain margin under compulsion. Now, unlike currency forward, here Utkarsh has to sell 1,000 future contracts on the dollar to hedge its projected income. Now, why 1,000? Because as discussed earlier, we sell and buy contracts in lots under exchange trade market, as this is more standardized. So here Utkarsh would sell 1,000 future contracts on the dollar to hedge its projected income. Now dollars foreign exchange futures have a contract unit of $1,000, which is a contract lot. So by selling 1,000 future contract on the dollar, he locks in a rate at which those dollar can be exchanged for INR after 4 months. 5 months here actually. 1 month he would take to manufacture those shirts and the additional 4 months of waiting period for the payment. So if the dollar depreciates against INR, the company's projected income would be protected against any depreciation in the value as per the locked-in rate. However, the clearing counterparty, just like under forward contract, any benefit that would occur if the dollar appreciates, Utkarsh would still be under compulsion to sell those dollars at the price of the future contract, which means giving up the gain they would have had if they had not sold the contract. So this is currency and future for you. Just a recap, let's check the difference between forward and future. Again, so it is an agreement to buy or sell an asset in the future date, or the pre-agreed price would be fixed at a time of entering into the contract, and both the contract being very similar to each other with some differences. A forward contract doesn't get traded on exchange, while future contracts do get traded, and there's a specific contract size for each contract that the parties enter into. And in forward contract, you need not maintain a margin in your account, whereas in future market, you need to maintain a margin for a sense of security. So the difference between them is same as the difference between OTC traded derivative and exchange traded derivative. So there is no risk of counterparty default. Here is a risk of counterparty default. This is more liquid because there's a sense of security due to the stringent rules and regulation. But here we have less liquidity because of low security, as no margin money is required to be deposited by any of the parties. This is mainly used by speculators and this used by hedgers. Now these are the two important participants in the market. We'll learn about them as we progress with our lessons. Now coming to the other two derivatives. So in options, they do not buy or sell the underlying directly, but buys or sells the right without obligation on the underlying. The right can be the right to buy, which comes under call option, and the right to sell, which comes under put option. Now let's check this with an example if you don't understand the definition. Now Utkarsh, being an importer here, is certainly apprehensive over the appreciation of dollar this time because he's the one to make payment to Alex. And now suppose spot rate at the time of entering was this, $1 equal to 60 rupees, and the forward rate for 4 months given by bank was $1 equal to 62 rupees. Apart from opting for a forward contract, is there any other derivative tool that helps him hedge the exposure of transaction here? Yes, option derivative can be used by Utkarsh here. Now, option, like the other derivatives, a contract for a specific underlying asset at a specific price, also known as strike price or exercise price, by a specified date, also known as X. But here only the right to buy the underlying asset is exchanged and not the underlying assets itself. But here only the right to buy or sell the underlying asset is exchanged and not the underlying asset itself. Okay? Your premium has a role to play, like the margin deposit by the user of the future contract. Premium, unlike margin, is an expense and is not returned to the user at all. Not even a percentage of the premium deposited by Utkarsh would ever be returned to him. It's an expense that he has to pay for entering into a option contract with the party. It is exchange traded formally. So your Utkarsh is apprehensive over the appreciation of dollar over a 4 month timeline. Over a 4 month contract till he makes the payment. So which of these two would be exercised by him if he chooses to hedge using option derivatives? So let me tell you what call option and put option. So let me first give you a background of call option and put option. So under call option, the call option holder has the right to buy while the seller has an obligation to sell. By exercising this, you limit your losses and there's a possibility of unlimited gains. And when is this exercise? When the investor expects an increase in price. So they buy at a lower price, and since they expect the price to increase, so they buy at a lower price because they expect the price of the underlying asset to increase in future. Whereas in put option, the put option holder has the right to sell, while the seller has the obligation to buy. Here the investor has limited gains. So which of these two options? Yes, he would use call option because he expects an appreciation in the price of the dollar. Because he expects an appreciation in the price of the dollar, and so he wants to hedge against the same. This is done so that if the dollar this is done now if the dollar appreciates, then Utkarsh can exercise his call option to hedge the exposure of the transaction here. Now as we know, there's a premium in this transaction. Now as we know, the user of option contract has to pay a premium. So here the premium for 4 months would be premium वाला काट देना फिर. Call options for 4 months would be ₹61 for $1. The rate of call option would be 61 rupees for $1 after a timeline of 4 months. And as we know that under option contract the user has to pay a premium, so here the premium for $1 would be 0.15 rupees for every dollar hedged. Okay, so this is called option for you. Now coming to the fourth derivative, the swap derivative. Now swap is an OTC traded derivative, and there are two kinds of popular swap used by investors. Firstly, interest swap, where two counterparties agree to exchange one stream of future interest payment for another based on a specified principal amount. In most cases, interest rate swaps include the exchange of fixed interest rate for a floating rate. And secondly, currency swap involves the exchange of interest and principal in one currency for the same interest and principal in another currency. And in order to understand the mechanism behind currency swap contract, let's consider the example of Alex, a US resident, is planning to expand its operations in India. His company requires rupees 1 million to finance its expansion in India. On the other hand, Utkarsh, that operates in India, wants to acquire a store in US to diversify its business. Now the acquisition deal requires $13,700. Now neither Utkarsh nor Alex holds enough cash to finance their respective projects in each other's country. So both of them now will seek to obtain necessary funds through debt financing in their domestic currencies at a lower interest rate, and then enter into a currency swap agreement with each other. Now Utkarsh obtains a credit line of rupees 1 million from Indian Bank with a fixed interest rate of 3.5%, which he has to pay along with the principal. After, let's say, 5 years, at the same time, Alex borrows 13,700 from US based bank with a floating interest rate, and both decided to create a swap agreement with each other. According to this agreement, both must exchange the principal amount at the beginning of the transaction, and in addition, the parties must exchange the interest payment semi-annually. So this creates a win-win situation for both Alex and Utkarsh for their respective endeavor. So now coming to the key economic functions that derivative plays in a country. So firstly, it helps to transfer risk from the people having low appetite for risk to the people having high appetite for risk. Because as we know, risk and return goes hand in hand. And the price of the derivative reflects the perception of market participants about the future and led the price of underlying to the perceived future level. Thus, it helps in discovery of future price. And now derivatives are also linked to the underlying cash markets, which results in higher trading volume. It also acts as a catalyst for new entrepreneurial activity as it attracts creative, well-educated people with an entrepreneurial attitude who create new business, new products in the economy. Okay, so these are the key economic functions played by derivatives in the market. With this, we come to an end of our second lesson. Don't forget to subscribe and click the bell icon for latest update. Thank you so much. Keep learning, keep growing.